We've seen a flush of issuance come out this year in anticipation of just this moment, people looking to lock in those better rates. What do your conversations with clients look like?
No, thank you, Sonali, so much for having me. And absolutely. So I think, like you had in your prior segment, the market is obviously pricing in additional rate cuts to happen over the course of the near term. I think remains to be seen whether that'll be 10 over the next 12 months. But equally, there likely will be some compression in rates that we're all expecting. That being said, when you think about rates today, it's still elevated versus where we've been for the last 10 years. And so investors are still very much focused on getting exposure to credit because from a total return perspective, from a yield perspective, you're still getting really attractive risk-adjusted returns.
We seriously hear that a lot, whether you go into credit markets as opposed to what you're seeing in treasuries for that extra yield. What does this mean for public versus private credit? Where does the investor demand go as you see the rate cutting cycle start to begin?
No, it's a great question, and we get it a lot. Obviously, liquidity has continued to be a focus from investors, particularly given the rise of private credit. And you've heard Apollo or others talk about how historically public credit was associated with good and liquid, and now private credit sometimes has a misnomer of being bad and illiquid. I think we're going to continue to see a convergence of those two markets, and we can talk about that more. But equally, I think from a public market perspective, it's also a tale of two cities, right? You have really liquid parts of the top end of the market, larger issuers, new issuance that you mentioned, and then when you go down to legacy exposure or more smaller companies, you actually have a lot of illiquidity in the public market. And the liquidity premium for public markets has actually near or about historical lows, whereas in the private markets, our expectation of what we're seeing is in sub-IG, you're still getting about 200 basis points plus for private credit vis-a-vis public. And in investment grade, you're actually almost doubling the spread that you can get in the public market. So at least for now, it still feels like private credit is a relative value that you want to play.
So this is fascinating because we, of course, reported this week that Apollo is partnering with State Street. You're looking to provide a private credit access in the form of an ETF. I know you can't talk about the filing itself. And also this idea that we reported on that Apollo is creating a trading desk to make this possible to begin with. But talk about the concept here. How liquid can these markets really get? I mean, what does all this retail access mean for the industry? Does it make the private markets look much more like the public markets anyways?
No, it's a great question. And you're right. I'm limited in what I can say. But equally, State Street is a leading asset manager. We're thrilled to be partnering with them. We can't say too much at the moment. But I think thematically at a high level, you've heard our CEO, Mark Rowan, talk about this convergence between public and private. This is emblematic of that in our view. I think you'll also continue to see, and there was news today as well, of traditional and alternative asset managers partnering to kind of bring broader access of alternatives to these more liquid type of structures. And I think that, Apollo is getting engaged in this facet as well as thinking through what do we think about investment grade markets, generally speaking, and should there be a bifurcation or are they coming together in terms of liquidity?
How do you think about this in terms of risky versus not risky? Apollo, of course, the old legacy of Apollo is in distress. The new legacy of Apollo is in investment grade credit. And so when you think about those companies that are still feeling the strain of higher rates, to your point, rates may stay elevated.
Right.
How many companies are still going to feel that pain if we don't see those 10 rate cuts? How does Apollo handle that?
I think you're spot on, and I think to your point, legacy Apollo, new Apollo, but we can debate. I think equally Apollo's credit business, as you well know, is very much focused on still high quality, top of the capital structure, secured type of risk. That doesn't mean that there won't be opportunities for opportunistic and hybrid businesses to delve into some of those situations. As you know, right, I think JP Morgan reported there was $50 billion worth of distressed activity over this year, which is incredibly high, and you're seeing that really in the floating rate market more than the fixed rate market, to your point on rates. And so I think what Apollo is going to try to do is focus on still high quality companies, fundamentally sound companies that may need additional structuring, LME or otherwise, and that are focused on good company, maybe suboptimal balance sheet versus diving down into kind of in our credit business, suboptimal company and suboptimal balance sheet.
What does this say about kind of what's coming to market right now? Because when you look at credit spreads, they are still so tight that you could argue that most investors are sitting around and ignoring the risks in the credit market. Yeah. But then you see bankruptcies also hitting the tape very significantly. So what is Apollo seeing kind of on that falling angel end of the spectrum? Are you seeing kind of a lot of companies out there that you just wouldn't touch at this point, given where we are in the economy?
I think in the high yield market, yes. I mean, the triple C market is difficult to kind of get engaged with. Not to say that we would never, but I think we're going to definitely be much more focused on picking our spots. And to your point, high yield spreads are where they are. If you take out the bottom 20%, you kind of have a really historical tight, what we've never seen in terms of high yield spreads. So it's definitely going to be about picking our spots.
So private credit once more, because I think this is an interesting aspect for all credit investors. Access is being made as we speak. But what does this mean in terms of future interest? As rates go down, how much interest will there be in private credit? Given so many instruments have been floating rate, you've seen also a lot of pressure on investors. That has been made fundraising, that hot fundraising we saw at the beginning of the year, start to taper off now. So where's that extra interest coming from, and what does that look like as rates start to subside?
No, it's a great question, and I think you've heard us talk about this before as well, but the wealth and high net worth, and retail market, I think, is incredibly instrumental in our growth and candidly the alternatives growth more specifically. It's a $200 trillion market, 5% in alts. And so if you believe that they're going to continue to diversify, get additional sources of income, additional sources of exposure, and really try to lean into the alts market, whether it's the announcements that we talked about earlier or otherwise, that's going to be a big area of growth for us. And I think equally on the institutional side, we speak to investors all the time. There's still a number of investors who are early in their private credit exposure days. And as we kind of take a step back and you think about return targets for a long time haven't really changed in terms of what investors are seeking to achieve. And when rates were zero, they leaned to more equity or higher risk strategies. Today, when rates are not zero, higher than zero, you're seeing people move across the risk curve.
What is it actually being offered to these retail investors? Because it's not like when they are investing in private credit, they are investing in, the next leverage buyout, right?
Yes.
I mean, what are the kinds of things that are being placed into those private credit portfolios?
Great question. I think it's about semi-liquid products that allow investors to get
Mortgages.
Yeah, mortgages. We can talk about in asset-backed finance, it's mortgages, it's resi, it's consumer. It's a diversified approach to everything that we're doing across the origination channels in various product forms.
About 30 seconds left here. What's the single biggest question your investors ask you right now?
I think the single biggest question is where are the unintended risks that I'm taking in my portfolio and how do I mitigate against it? And a lot of what we've been talking about with investors is shifting your private credit allocations to investment grade as well to start thinking about a holistic fixed income portfolio, which is a big theme of ours.